Monday, November 23rd, 2020, Maneco 64, home of alternative economics and contrarian views. So we're going to look at inflation and deflation today. There's a lot of debate about whether we have inflation or deflation, but I'm going to make it very simple. I'm going to go back to the dictionary from 1973, the Webster's Merriam-Webster Pocket Dictionary. And why 1973? Well, because that was right around the time that the monetary system was being basically overhauled, just after Nixon closed the gold window in 1971 and made the whole world's monetary system a fiat currency system. 1973 was the year that currencies started floating against each other, floating exchange rate. It might seem normal that we see currencies floating against each other or trading up and down against each other, but it's totally crazy, really, because it's like having different measuring sticks for, let's say, for distance, for weight, or for height, and changing them every day. It makes the world a much more complicated and difficult place, and that's why our economies, the middle class, the working class, have suffered so much from this system. And why do I look at the definition from then? Well, because the powers that be, and that is universities, academia, the banking class, the political class, they had to change the definition of inflation in order to fool people into thinking that we don't have rising prices. So usually I just look at the definition of inflation, but I'm going to actually start with the definition of deflation that they have here. So let's see what they say about deflation. Reduction in the volume of available money and credit resulting in a decline of the general price level. Okay, so I just wanted to show you a chart before I go and look at inflation. So this is M2 money supply, which is M1 plus M2. It was 1.591 trillion back in 1980. And where are we now? Well, we're almost at 20 trillion. So is that a decrease in the supply of money? No. What about the credit? Let's just look at the national debt of the United States. Back in 1980, it was just below a trillion. We're now approaching 30 trillion. Is that a decrease in the amount of credit? Well, why credit? Well, because the debt is conjured up through the issuance of credit, treasuries, U.S. Treasuries, the bond market. What about all the corporate debt? I mean, that's gone up through the roof as well, right? So we don't have deflation, Mr. Bond King, or whoever, or Brent Johnson, the dollar milkshake guy. We have inflation. So let's look at the definition of inflation before I show you how prices have done according to Shadow Stats, John Williams. So inflation, an abnormal increase in the volume of money and credit resulting in a substantial and continuing rise in the general price level. So it's the complete opposite of deflation, right? And it's not the CPI, it's not the PCE. That's the way the government measures the price rises, and they've been changing the way they measure this for 40 years, as John Williams says. I think the first change was that instead of using house prices for the housing component of CPI, they started using rental, how much rent you would get, how much rents increased. But that's a totally bogus, how can I say, measurement. The other thing they've done over the years, they've used substitution. If something becomes too expensive, they'll take it out of the basket and replace it for something cheaper. So, for example, If you used to eat fillet steak, but it got too expensive, they now put Spam in there. Hedonics is the other thing. Let's say an automobile cost $15,000 in 1990 to buy, and now it costs $35,000. According to them, the price hasn't changed, or it has even gone down because there's been a lot of improvements in the automobile. But if your wages haven't kept up with this adjustment, it doesn't really matter. You're still paying a lot more for that car, but in the CPI calculation, they don't calculate it as going up. The other thing they do is they strip things like food and energy when they're basing their calculations of inflation. They call it the core CPI. I mean, who needs food and energy, right, to survive? So they tell us that the fact that it's between 1% and 2% is deflationary and that it's a problem. But that's not even inflation or deflation, right? The CPI, that's the result of it. So they've confused everyone into thinking we don't have inflation, even though you've seen that we have inflation. So now let's look at shadow stats, because what John Williams does is he just tracks CPI, how the government did back in 1980 and in 1990. So the 1980 base CPI, as you can see here, since the year 2000, has been running around 10%. Yes, it dropped down to like 5%, just above 5% during the '08 crisis. But if you look here, it's pretty much above and below that 10%. I would say it's probably running around 9% on average, right? And then you've got the way they calculated it back in 1990. It's running between 4 and 6%. By 1990, they had already tinkered quite a bit with that CPI. But the way they calculate it now, as you can see here, CPIU, it's like between 2.5 and 0. And it's not the real rate of prices, right? Price rises, right? And this is not inflation. This is CPI. Don't forget. I even sometimes use the terms interchangeably, and you see in the mainstream media, like recently The Guardian here in the UK said that rising prices of secondhand cars were causing inflation. Well, they got it backwards, right? Because it's the inflation of the money and credit that's causing the decrease in value of the currency, and that's leading to higher prices. So it's very simple. Your currency gets devalued. You need more of that currency to buy real things. So prices of things that you buy or services, they don't really go up. The service doesn't really get more expensive. It's the currency that goes down in value because the central banks and the government are creating so much of it. It's the simple law of supply and demand. So just before I look at the markets this morning, just wanted to show you this chart here, or this set of data. And this is from Incrementum, from their In Gold We Trust report for 2020. It gives you gold performance since 2001 in various currencies. We'll look at the dollar here. It's the second column after the euro. So gold has averaged a return of 10.7% over that period from 2001. So we saw that the CPI, as calculated by the government in 1980, is running around 9-10%, sometimes a bit lower. So you can see how gold has been a perfect hedge, really, for the inflation of the money supply. And is it any wonder that people are struggling? I mean, I saw the other day these lines of cars, or queues of cars, as we would say in the UK, in Dallas and other places in the US, of people, miles of cars, people waiting to get free food or at a food bank because they can't afford to buy food. Is that a world where prices are stable, where the standard of living is rising? No. And those kinds of things are the anecdotal evidence that we have inflation, and that deflation is really an excuse the powers that be, central bankers, economists, and politicians use to continue to inflate. And that's why I get annoyed with people that are supposedly in the alternative who say we have a deflation problem. So hopefully I've put that question to rest, even though I think a lot of people are still gonna question and like not agree with me, but that's their prerogative. This is my opinion, but I think it's pretty well backed by facts. Anyway, let's look at where the markets are this morning. It's 9:02 a.m. London time. Of course, we've got more news about vaccines this morning. It's Monday, right? So today we've got news from the UK. AstraZeneca, Oxford University say vaccine show high efficacy. So that's out there. Gold is at 1870. So the range has been 1876 to 1867. So we're down just over $1. Silver is trading at 24.04, down 12 cents. It has been as high as 24.42, and the low's been 23.95. So the Dow futures up 200, 29,450. S&P is up 22. So we're up about 2/3% in the stock market. The NASDAQ 100 futures up less than 0.5%. FTSE is up 1/3. Currencies are quite strong here, especially the pound. Not too sure why. The pound is up 90 pips, or 2/3% at 133.77. Yes, I've noticed the price of gold in pounds has dropped quite a bit. Well, that's good news because that means you hopefully will be able to get physical gold and silver cheaper than you could. I mean, they're talking now of a budget deficit in the UK for the current fiscal year of around at least 25% of GDP. I mean, if that doesn't worry you, I don't know what will in terms of the fiscal situation of this country. Anyway, the euro is up 0.1% at 118.75. The dollar is down slightly versus the yen at 103.77. Dollar's up slightly versus the yuan at 6.56. Crude oil is very strong. It's up 2%. WTI at 43.24. To finish off, the 10-year yield is up 2 basis points at 0.85. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.